Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Vishay Intertechnology.
If you find our talks useful, please consider subscribe, like, and comment underneath. And just a quick note before we jump in, you'll hear us mention some trading tools today, so make sure to check out the VIP Algos link below in the description. Now, I want you to imagine that you are tasked with building a $100 million AI supercomputer.
Okay, that sounds like a massive headache already.
Right. I mean, it's a huge project. So you get the absolute most advanced processors on the market. You rig up this crazy liquid cooling system, you flip the switch, and the entire system just melts down.
Just completely fries itself.
Exactly. And why does it happen? Not because the flashy, cutting-edge AI chips failed. No, it fails because a 10-cent resistor, a tiny piece of unsexy legacy hardware, just burned out and couldn't handle the power surge.
Which is wild to think about.
It is. And that 10-cent piece of hardware is actually the center of one of the most bizarre, mind-bending financial situations happening on Wall Street right now.
Yeah, the sheer scale of the disconnect we are seeing here is frankly staggering.
Right.
Because usually, the market operates on at least a loose connection to fundamental gravity. Like, if a company does well, the stock gradually goes up. If analysts crunch the numbers and assign a value to the business, the stock generally trades somewhere in that neighborhood.
Makes sense. That's how it's supposed to work.
Right. But the setup we are looking at today completely shatters that model.
It really does. So for context, we are looking at Vishay Intertechnology, ticker symbol VSH. They're a legacy semiconductor and electronic component company. And recently, their stock has just gone on an absolute tear, surging nearly 300%.
It's parabolic.
Yeah. To put the actual numbers on it for you, year to date, the stock has returned 274.1%.
Right.
And over the past year, it's up 287.2%.
Wow.
They're currently trading around, I think, $57 to $58 a share. But here is the massive catch. The smartest analysts in the room, we're talking about the heavyweights at Bank of America and JP Morgan, they have median price targets sitting way down at $20 to $28.
Which is, that's a valuation literally cut in half.
Yeah.
That is not just some minor disagreement over future earnings multiples. That is a fundamental fracture in reality.
Totally.
You've got retail traders and momentum algorithms looking at Vishay and pushing it to the moon because they're convinced it's the ultimate underdog play in this whole AI and EV boom.
Right.
But meanwhile, the institutional side is staring at the exact same balance sheet and bracing for a total collapse.
So our goal today is to unpack this. We're going to look strictly at the numbers to explore their business transformation, which they're calling Vishay 3.0.
A very catchy name.
Yeah, very Silicon Valley of them. We're going to look at the staggering capital they are burning through to build factories and ultimately determine if this stock is a brilliant, overlooked engine of the future or just a really fragile bubble waiting to pop.
Well, to understand the bubble argument, you have to look at the market mechanics driving the stock right now. If you look at the technicals, financial news feeds are universally flagging Vishay with a very specific warning.
Right, I saw this.
Yeah, they are calling it the most overbought that it has ever been.
Now, most overbought ever. That sounds dramatic, but what does that actually mean mechanically for the people trading it?
It means severe exhaustion risk.
Okay.
When a stock goes parabolic, meaning it shoots almost straight up on a chart, it isn't being driven by, long-term value investors who are carefully accumulating shares over months.
Right. It's not Warren Buffett slowly buying in.
Exactly. It's a stampede. You have sector rotation funds, algorithmic trading bots, and retail traders all rushing through the exact same door because they are terrified of missing the next big chip rally.
The FOMO is real.
Oh, absolutely.
Yeah.
But eventually, everyone who wants to buy has already bought in. And when there is no fresh money left to push the price higher, the momentum stalls.
And then what happens?
The moment it stalls, those same algorithms instantly switch to selling to lock in their profits, which can trigger a violent crash.
It's like the financial equivalent of a blockbuster movie release.
How do you mean?
Well, audiences are packing the theaters, the box office is breaking records, people are cheering, but the professional film critics are screaming that the script makes absolutely no sense and they're giving it 0 stars.
That's a great analogy, actually.
And the flow of insider money tells an incredible story about how unpredictable this narrative has become. There's this fascinating anecdote about a U.S. congressman who was tracking Vishay.
Oh, right. I saw this in the data.
Yeah. He bought into this company really early, spotting the fundamental drivers, like the onshoring of manufacturing and the growing demand for hardware. But he actually sold his position long before the massive 270% surge really took off.
Which perfectly illustrates the difference between a fundamental investment and a momentum casino.
Yeah, exactly.
He likely saw a solid turnaround story, took a very reasonable, rational profit, and stepped away.
Just took his money off the table.
Yeah, and then he had to watch from the sidelines as the market completely lost its mind and drove the price up another 200% based purely on hype.
It must have been frustrating, but also predicting a fundamental turnaround is difficult enough. Predicting a 300% retail squeeze, that is nearly impossible.
It really is.
So to figure out why the momentum crowd is so euphoric and why the institutions are screaming that it's overpriced, we need to leave the stock ticker behind for a second and walk onto the actual factory floor.
Let's do it.
Let's look at the actual business and the Q1 2026 financial turnaround, because honestly, the numbers are pretty solid. Net revenues surged 17.3% year over year to $839.2 million.
Which is huge.
It is. That actually beat the high end of their own management's guidance.
And they also returned to GAAP profitability.
Right. And just for anyone listening, GAAP just stands for Generally Accepted Accounting Principles.
Yeah, it means this is standard, rigorous accounting. No fuzzy math here.
Exactly.
They posted $7.2 million in net earnings, which comes out to 5 cents per share. And that is a major reversal from the losses they were posting just a year ago.
Right. They were bleeding money before.
Exactly. And even more importantly, their gross margins improved to 21%.
I do want to pause on their products, though, because this is where my confusion really sets in.
Okay, why?
Well, when you hear semiconductor companies soaring 300%, your brain just defaults to artificial intelligence, right?
Sure, yeah. NVIDIA, AMD, all of that.
Exactly. You picture those microscopic multi-billion transistor GPUs that power massive data centers. But VI doesn't make those. They make discrete semiconductors and passive components.
Right.
The breakdown specifically lists MOSFETs, diodes, capacitors, and resistors. I mean, I can go on Amazon right now and buy a plastic bag containing 1,000 basic resistors for about $5.
You definitely can.
So how do you build a multi-billion-dollar market cap out of something so incredibly basic?
It helps to think of the technology sector like building a house.
Okay.
The flashy AI processors and the complex software, those are the beautiful architecture, the smart appliances, the massive flat-screen TVs. But Vishay makes the plumbing. Yeah. They make the valves, the pipes, the pressure regulators. Passive components like resistors and capacitors, they don't generate power. They regulate it, they store it, and they filter it.
Got it.
And discrete components like diodes and MOSFETs, they act as one-way valves or electronic switches for the electricity.
Okay, so plumbing isn't exactly glamorous, but without it, the whole house floods.
Precisely. Take an electric vehicle, for example. When you step on the brakes in an EV, the regenerative braking system sends a massive, violent spike of voltage back into the battery to charge it.
Oh, right.
If a Vishay MOSFET doesn't switch that power perfectly, or a diode doesn't prevent that current from flowing backward, the battery degrades. Or worse, it catches fire.
Wow. Okay, that's a big deal.
So while the component itself might seem simple, its role is absolutely critical to the system surviving.
That definitely explains the demand. Every AI server rack, every electric vehicle, every smart grid out there needs thousands of these little plumbing parts. But again, anyone can make a resistor. If the technology isn't cutting edge, where is Vishay's competitive moat? Why don't their customers just buy the $5 bag of generic parts from overseas?
Well, the moat is built entirely on high reliability qualification. We aren't talking about the resistor that goes into your kitchen toaster.
Right.
Vishay specializes in components for aerospace, defense, and automotive systems.
Okay, the stakes are a bit higher there.
A lot higher. If you are Lockheed Martin building a missile guidance system or Ford building an EV drivetrain, you cannot just solder in some generic part. You need a component that has survived extreme thermal cycling.
What does that mean, practically?
It means baking it in an oven at 150 degrees Celsius for thousands of hours, then violently vibrating it, then blasting it with radiation.
So they're essentially selling certified survival gear for electronics.
That's a perfect way to put it. And that testing and qualification process takes years.
Years. Just for a resistor.
Yes. An automotive manufacturer will spend 2 or 3 years testing a specific Vishay MOSFET before designing it into a new car platform.
Oh, wow.
And once Vishay is designed into that system, the switching costs for the customer become astronomical.
I see. Because if they want to switch to a competitor just to save a penny on a diode, they have to retest the whole system all over again.
Exactly. They aren't going to halt a billion-dollar production line, redesign the circuit board, and spend another 2 years running safety tests just to save a few cents per unit.
That makes total sense.
So once Vishay gets their components designed into a product, they essentially own that real estate for the entire life cycle of the vehicle or the server rack. The customers almost never leave.
Okay, so if they have these incredibly sticky customers and revenues are growing past $830 million, they should be absolutely printing money.
You would think so.
But when you look at the financials, they are actually bleeding cash. In Q1, they had a negative free cash flow of $46.9 million. How is a company with such a brilliant moat losing $46 million in 3 months?
Well, it's because of capital expenditures, often called CapEx. This is the actual cash they are lighting on fire today to build the physical factories they are going to need for tomorrow.
Right, the Vishay 3.0 strategy.
Exactly. They are in the middle of a massive, heavy investment cycle. They are prioritizing massive long-term capacity over short-term cash conservation. In that single quarter alone, they spent $110.7 million on CapEx.
That is a staggering amount of money. And where is all that going? Building a factory to make tiny resistors can't be that expensive, can it?
It is astronomically expensive because they aren't just pouring concrete and putting up walls. They are building clean rooms that are thousands of times cleaner than a hospital operating room.
Oh, sure.
Specifically, they are ramping up a facility in Newport and building a massive new 12-inch wafer fab in Itzehoe, Germany.
Okay, a 12-inch wafer fab. Why does the size matter so much?
Well, moving from older 8-inch silicon wafers to 12-inch wafers is a huge technological leap. When you increase the diameter of the wafer, the actual usable surface area more than doubles.
Basic geometry. Pi r squared.
Exactly. That means you get dramatically more chips per wafer, which eventually drives your unit costs straight into the floor.
So long-term, it's incredibly profitable.
Yes. But the upfront cost to build the robotic fabrication lines that can actually handle those larger wafers is staggering.
Let's put this in perspective with an analogy for the listeners.
Okay.
Let's say you own a highly profitable neighborhood bakery.
Right.
The croissants are amazing, you have a line out the door every morning, and your customers refuse to eat anywhere else.
That's your moat.
Exactly. But to meet the growing demand from a huge new hotel that's being built across the street, you decide to take out a massive multi-million-dollar mortgage to build a giant, fully automated commercial kitchen.
Makes sense on paper.
It does. But you were doing this right at the exact moment the broader economy is starting to look a little shaky. If that hotel delays its grand opening by even a few months, you still have to pay that massive mortgage and your bakery is suddenly crushed by the debt.
And that right there is the precise mechanism behind the bear case for Vishay.
The debt burden.
Yes. Vishay is sitting on a mountain of debt right now. Their total debt is $983.1 million.
Wow. Nearly $1 billion.
Yes. Nearly $1 billion in debt against just $479.4 million in cash.
That's a scary ratio.
It is, because when you build massive new factories, your fixed costs skyrocket. You have to pay for the facility, the maintenance, the specialized staff, regardless of how many chips you're actually selling.
Right.
You need massive, uninterrupted revenue volume flowing through that factory just to break even on those fixed costs.
So if EV adoption slows down even slightly, or if tech companies pull back on building these AI data centers, Vishay's margins don't just shrink, they collapse entirely.
That is exactly what is keeping JP Morgan and Bank of America analysts up at night.
Understandably.
However, Vishay isn't flying completely blind here.
Yeah.
They do have a massive shock absorber built into their business model, which is their backlog. Right now, they are sitting on a $1.59 billion backlog of orders.
$1.5 billion already on the books.
Yeah.
So going back to the bakery analogy, that means you took out the massive mortgage, but you already have signed non-refundable catering contracts for the next 3 years to guarantee you can make the payments.
Exactly. That backlog is their life raft. It makes their current leverage manageable. It provides enough forward visibility that management actually felt comfortable maintaining their quarterly dividend.
Oh, that's a good sign.
It is, though they did make the very prudent decision to pause all share repurchases until these heavy capital needs subside.
Well, that's just smart business.
Well,
Okay, so the high wire act here is pretty clear. On one side, nearly $1 billion in debt and heavy cash burn. On the other side, $1.5 billion backlog and a totally captive customer base.
right.
Now we need to look at what will actually trigger a massive success or a massive failure in the near future. Walk me through the doomsday scenario here, because analysts still have that $20 price target, and their models flag this stock as 68% overvalued compared to fair value estimates.
Yeah, so that 68% overvalued metric comes from discounted cash flow models. Right. Analysts project out all the money the company's going to make over the next decade, and they discount it back to today's dollars. Even if you assume Vishay executes their expansion perfectly, the math suggests the underlying business is only worth about $24 a share.
Wait, $24?
Yeah.
But the stock is trading at like 58.
Exactly. To justify the current $58 price tag, you have to assume they aren't just going to execute perfectly, but that they will experience an absolute miracle of sustained hypergrowth without a single misstep along the way.
And in global manufacturing, there are always missteps. Always.
Always. The immediate test is going to be their upcoming Q2 2026 earnings, which we are expecting around July or August. The market is going to be laser-focused on their execution.
What are the specific targets they need hit?
Management guided for revenues between $875 million and $905 million, with gross margins hitting 22%.
And if they miss that?
If they miss that 22% margin target by even a fraction, the consequences will be severe. The momentum algorithms driving the stock do not care about Vishay's long-term 2028 strategy.
No, they care about the next 10 seconds.
Exactly. They care about quarterly perfection. Plus, we are currently operating in an environment of elevated raw materials costs, and there is the constant looming threat of new trade tariffs.
Oh, right.
If the cost of the raw metals needed to build these components spikes, or global supply chains get hit with tariffs, the cost to produce goes up.
And because their customers are locked into those long-term contracts we talked about, Vishay might not be able to immediately pass those increased costs onto the buyer.
Exactly.
Which means that 22% margin just evaporates.
Goof. Gone. And the execution risk on the new factories is just as high. If that 12-inch wafer fab in Germany faces construction delays or software integration issues, the massive fixed costs start eating into their cash reserves immediately, while the expected revenue gets pushed further and further into the future.
But to be fair, there are also massive macroeconomic tailwinds pushing from the other direction.
Yeah.
Right? I mean, governments are throwing money at companies like this.
Oh, they absolutely are. We are seeing a massive push for onshoring and defense stimulus.
Right.
The U.S. and German governments have realized that relying on vulnerable overseas supply chains for the critical discrete components that go into their military defense systems or their national energy grids is a massive national security risk.
Yeah. You don't want your missile guidance systems relying on parts from a geopolitical rival.
Exactly. And Vishay has a strong manufacturing footprint in the U.S. and Europe, which suddenly elevates them from just being a component supplier to being a strategic geopolitical asset.
Which naturally leads us right into the speculative rumor mill.
Oh, yeah.
Because you can't have a stock surge 300% without people whispering about a buyout.
Yeah.
There is unconfirmed market speculation, and we really have to stress for you listening that this is purely unconfirmed. That Vishay's legacy turnaround and these new state-of-the-art fabs could make it a prime acquisition target.
Yeah, the logic behind the rumor makes a lot of sense from a purely strategic standpoint.
Who would be buying them?
Well, massive analog semiconductor giants like Texas Instruments or Analog Devices, they are constantly looking to vertically integrate and expand their power management portfolios.
Okay.
So buying Vishay right as they finish the expensive, painful process of building a 12-inch wafer fab in Germany, that might look incredibly attractive to a larger player who wants to instantly acquire capacity and a massive backlog of locked-in defense and automotive contracts.
Basically letting Vishay do all the hard work and then swooping in to buy the finished factory.
Exactly.
But you cannot base a long-term investment thesis on the hope that someone else will come along and buy the company.
Oh, that's a dangerous game.
So that brings us to the ultimate synthesis of all this data. Let's talk about the final verdict. When you look at the fundamental timeline, this Vishay 3.0 transformation is a long-term 2 to 3 year hold story. The revenue growth is real, the moat is deep, and the surging demand from AI and EV sectors is undeniably real. But the 300% parabolic run has created a massive valuation disconnect. So how do we score this?
Well, if we were looking at an investment rating or a bullish score, you really have to split it up. Short term, this is maybe a 3 or 4 out of 10.
Because of the exhaustion risk.
Exactly. The momentum traders treating this as a short-term swing trade are literally playing with fire. The technical state is severely overbought. The gap between the $58 share price and the $24 fundamental fair value is a terrifyingly long way to fall if the narrative cracks, if a factory gets delayed, or if a tariff hits their margins.
Well, long term.
Long term, if you're looking out 3 to 5 years and they execute this 3.0 strategy perfectly, it's a very solid business. The long-term view is much more favorable, maybe an 8 out of 10 on the fundamentals alone. The business is making the right moves for the decade, but the stock price is living in a fantasy for the quarter.
Right. But we do want to be super clear here. We do not tell you to buy, sell, or hold. We're just laying out both the massive upside of their moat and the very real downside of their debt burden and valuation. You have to make your own decision.
Absolutely.
It is the classic scenario where a fundamentally solid, strategically vital company might actually be a terribly risky trade at this exact moment.
Right.
Which leaves us with a fascinating paradox to end on. Before we do, though, please don't forget to like, subscribe, and hit the comments. And remember to check out that VIP Algos link down in the description to help you navigate wild setups exactly like this one.
You definitely want to have the right tools when a stock is moving 300%.
Seriously.
Yeah.
So throughout this whole talk, we've talked about how unsexy Vishay's products are, right? Resistors, capacitors, diodes.
The invisible plumbing.
The invisible plumbing of the electronic world. When you read the headlines about the AI revolution or the transition to a fully electric grid, everyone focuses on the flashy software, the brilliant algorithms, and the sleek design of the finished cars.
Because that's what we interact with.
Yeah.
You know, the user interface captures all the imagination and, frankly, all the headlines.
Right. But consider the mechanics of what we've unpacked today.
Yeah.
I want to leave you with a broader question to mull over as you watch the market over the next few months.
What's that?
What happens to the entire global technology supply chain when these legacy hardware makers, the ones forging the physical, unglamorous nuts and bolts of the digital age, suddenly realize they are the ultimate bottleneck?
That's a scary thought.
Because you can design the most brilliant AI software in human history, and you can build a $100 million supercomputer to run it. But without a 10-cent diode to manage the power, the whole system goes dark.